Money moves faster than governments, and someone built the system that makes it happen. Just 10 firms clear 80% of global trades, while algorithms decide prices in microseconds. You think markets are free, but most are wired together. From Wall Street to Zurich, the same names reappear. So when every market moves at once, who's actually pressing go? No one voted for it, but somehow every market on Earth is now wired into one system. Stocks, bonds, oil, crypto, everything moves together. A tremor in Tokyo can shake traders in New York within seconds. There was a time when markets were local, when a stock exchange in London had little to do with grain prices in Chicago. That time ended decades ago. After the 1970s, the rules of money changed. Deregulation swept through the US, Europe, and Asia, opening walls that once separated banks, brokers, and insurers. Countries dropped currency controls, computers replaced chalkboards, and new trading systems started linking continents. By the mid-1980s, a trader in Hong Kong could bet on American bonds before sunrise in New York. Technology turned markets into one global nervous system, and no one slowed it down. Then came the rise of the big connectors, the nodes that tied everything together. Clearinghouses like DTCC in the US and Euroclear in Belgium became the unseen gears of the system. Every trade, from a Tesla share to a French government bond, passes through their servers. Together, they process over $2 quadrillion worth of transactions every year, more than 20 times the world's GDP. These are the silent pipelines that make capitalism run. However, the real glue came from asset managers, the big three, BlackRock, Vanguard, and State Street. By pooling trillions from pension funds and governments, they turned investing into an automated empire. Today, their combined control over global equities exceeds $25 trillion. That's enough to own a slice of almost every major company on Earth, from Apple to Exxon to Nestlé. Therefore, when they move, markets obey. At the same time, data firms like Bloomberg and Refinitiv became the eyes and ears of this new order. They decide what prices the world sees, what trends appear real, and what remains hidden behind paywalls. Money now depends on information, and information flows through them. So now, every transaction, every click, and every stock price forms part of one living web. Too fast to see, too vast to control. But as this network grew, a smaller group began to own its gates, and that's where the next part of the story begins. Inside the quiet offices that decide who owns what. Everyone talks about competition, but when you look close enough, the same names keep showing up behind every company. Coca-Cola and Pepsi, both owned by the same top shareholders. Apple and Microsoft, same again. By 2025, three firms, BlackRock, Vanguard, and State Street, together manage over $25 trillion. That's more than the GDP of the United States. These firms don't run ads. They don't sell products. They quietly hold the voting rights for almost every major public company. Therefore, when corporate boards meet, the biggest voice in the room often belongs to one of these three. Through index funds and ETFs, they own pieces of airlines, oil companies, tech giants, and even your local bank. But this control wasn't built overnight. In the 1980s, deregulation and pension reforms in the US and Europe flooded the markets with long-term money. Small investors didn't want to pick individual stocks, so they trusted index funds instead. That's when Vanguard, led by John Bogle, offered a simple deal. Buy everything, hold it forever. It sounded harmless, but it turned the firm into a silent owner of the world economy. By the time Larry Fink founded BlackRock in 1988, computers were already starting to take over finance. His idea was to manage risk using data, not intuition. That idea turned into Aladdin, a super system that now monitors over $21 trillion in assets worldwide. Aladdin's algorithms don't just track markets. They advise central banks, governments, and insurance companies. Therefore, when Aladdin signals danger, global finance listens. Meanwhile, clearinghouses such as DTCC and Euroclear ensure every trade lands safely. They handle about $6 trillion in securities a year, meaning if they stopped for one day, global finance would freeze. These are the gatekeepers. No one elected, but everyone depends on. So the next time a stock chart moves, remember, it may not be competition driving it. It could be three firms sharing the same table. And behind those firms, something even faster began to rise: code that never sleeps. There was a time when trading floors were loud, full of shouting men waving papers. Now they're quiet. Rows of servers hum where humans once stood. More than 70% of all U.S. stock trades are done by machines. They react in milliseconds, faster than any person could even blink. In the early 2000s, high-frequency trading changed everything. Firms like Citadel, Virtu Financial, and Jane Street built computer systems that read prices, predict moves, and to execute thousands of trades per second. They make fractions of a cent on each trade, but they repeat it millions of times a day. Therefore, small profits turn into billions. One famous example came in May 2010 when the flash crash wiped nearly $1 trillion from the U.S. stock market in minutes. No terrorist attack, no political event, just a feedback loop between algorithms gone wild. Prices collapsed and recovered before regulators even knew what happened. That moment showed the world who really drives the market now. These trading programs don't think, they respond. They follow patterns, detect volume changes, and chase momentum. A rumor, a mistyped command, or even a tweet can cause global ripples. However, the people behind these machines, the quants, are the new power brokers. Many come from physics labs and math departments, not Wall Street families. They write the language that money understands now, code. And then there are dark pools, private trading networks run by big banks where deals happen in secret, away from public exchanges. Around 40% of U.S. stock trading flows through these hidden systems. It helps large investors buy or sell without moving prices too much, but it also hides who's buying what. Therefore, while markets look transparent on your screen, most of the real action happens out of sight, between algorithms talking to each other in microseconds. Yet even the fastest code needs something else: data. Raw, constant, expensive information. And the ones who sell that data built their own quiet empire. Every trade begins with data. Prices, news, rumors, and even satellite photos all turn into numbers before anyone makes a move. Whoever controls that flow controls the game. Therefore, in modern finance, the real power doesn't come from cash. It comes from information. In the 1980s, Michael Bloomberg changed the business forever. His idea was simple but genius: give traders instant access to every market number on one screen. That screen became the Bloomberg terminal, the most powerful financial tool ever made. Today, over 325,000 terminals sit in offices from Wall Street to Hong Kong. Each one costs around $25,000 a year to rent. That means Bloomberg earns nearly $9 billion annually just from access to data. However, they are not alone. Refinitiv, owned by the London Stock Exchange Group, feeds real-time prices from more than 500 exchanges and 2,000 data sources. Then comes Intercontinental Exchange, ICE, the company that owns the New York Stock Exchange. ICE doesn't just run markets. It sells the information those markets produce. Together, these firms form the brainstem of global trading, where data flows before money moves. Milliseconds matter here. A delay of 0.001 seconds can cost a trader millions. That's why firms pay huge sums to move their servers closer to stock exchanges, shaving distance to gain speed. In Chicago, fiber cables were laid in straight lines just to save 3 milliseconds between trading hubs. Sounds tiny, but in a world where code acts faster than thought, it decides who wins. Then come the rating agencies, Moody's, S&P, Fitch. With one downgrade, they can raise a country's borrowing costs overnight. When Greece lost its investment grade in 2010, billions vanished in hours. These ratings guide trillions in bonds, yet the agencies answer to no voters, only to their shareholders. Therefore, the world's biggest fortunes move based on information a handful of firms choose to release. And when those firms fail, chaos doesn't spread slowly, it jumps. Every crisis starts the same way. Fear spreads faster than facts. One bank fails, one fund collapses, and within hours, the whole world shakes. But when markets panic, the same names always step in. The same people meet behind closed doors, and somehow, the system survives again. In 2008, when Lehman Brothers fell, global trade almost froze. Banks stopped trusting each other, and money itself began to dry up. Within days, central banks around the world, the Federal Reserve, the European Central Bank, and the Bank of England, coordinated emergency loans worth over $3 trillion. They didn't act alone. Asset giants like BlackRock and Goldman Sachs were brought in to design the rescue programs and manage toxic assets. Therefore, the companies that helped inflate the bubble also helped clean it up and got paid billions for it. During the COVID-19 crash in 2020, the same pattern repeated. The U.S. Federal Reserve quietly hired BlackRock again to run its corporate bond buying program, worth $750 billion. Within weeks, stock markets recovered while small businesses vanished. The money flowed through the same channels to the same institutions. The names never changed, only the reason did. Then came 2022, when inflation returned for the first time in 40 years. Central banks tightened policy together, raising rates almost in sync. The Federal Reserve, the European Central Bank, the Bank of Japan, and the People's Bank of China all moved within months of each other. It looked coordinated because it was. Global liquidity is now so connected that one decision in Washington instantly moves prices in Mumbai or Sao Paulo. However, every rescue comes with a price. Each intervention gives the network more control. The system learns how to prevent collapse, but also how to shape behavior. Therefore, every crisis strengthens the very web it nearly destroyed. And now that web has grown into something else, an operating system for the entire economy. Every part of money now runs through one grid: banks, markets, governments, even your phone. What started as a network of trades has become a system of control. The question now is simple but huge. Can anyone live outside it? After 2008, trust in old finance broke down. Therefore, in 2009, a new idea appeared: digital money. Bitcoin promised freedom from banks, coded by a mysterious figure named Satoshi Nakamoto. It was meant to be open, borderless, untouchable. However, within a decade, big investors and institutions turned it into another market to control. By 2024, over 90% of Bitcoin trading volume runs through a handful of centralized exchanges like Binance, Coinbase, and Tether, many linked to traditional finance. So the cycle returned. Independence became another form of dependence. At the same time, central banks started building their own version, central bank digital currencies, or CBDCs. The Bank of China already runs one for more than 260 million users. The European Central Bank and U.S. Federal Reserve are testing digital dollars and euros. The idea is simple: trace every transaction, remove cash, and control the money supply in real time. The Bank for International Settlements in Basel is coordinating this push across more than 130 countries. That means the same quiet network that managed gold, debt, and crisis now prepares to manage digital money too. AI adds another layer. Platforms like BlackRock's Aladdin now analyze billions of data points daily, predicting risks before they happen. Governments use similar systems to monitor trade, energy, and credit. Therefore, the global economy has turned into an operating system where policy, code, and currency run on the same software. So when every transaction, loan, and algorithm connects through the same digital veins, the question becomes clear: who holds the switch? And maybe control no longer hides behind smoke-filled rooms or secret meetings. Maybe it hides in plain sight, in the code that everyone uses but few understand. If this story opened a few doors you didn't know existed, stay curious and subscribe. Thanks for watching.